All right, so we're talking about sentiment, market sentiment, and we just talked about VIX. So the second factor that influences market volatility, and I remember I mentioned to you, not volatility, market sentiment. We've talked about VIX, so I'm thinking about volatility, but it's not. Market sentiment. It's percentage of stocks in the S&P 500 trading above or below moving average. And here's the thing, we have 20-day moving average, the 50-day moving average, the 150 moving average, and the 200-day. And the ones that I look at are the 50 and the 200, okay? These are the most popular moving averages, the 50-day moving average and the 200. That's the ones institutional traders look at. They don't really look at 20 too much or 150 too much, but 50 and 200. And what I'm looking at is, see, it's easy to look at the S&P 500 with a moving average and say, okay, it's trading above or below moving average. But I want to take a deeper look. I want to see at the percentage of stocks trading above or below. And let me explain to you why. And this is something you're not going to learn anywhere else, unfortunately. The S&P 500, most US indexes are weighted indexes. What does that mean? That means not all stocks get equal share. That means if you're trading Apple or Amazon or Microsoft, the influence that that stock has on the index can be 100-fold, and I mean 100-fold over a smaller stock. So when you're trading when you're looking at price action on the S&P, what you're really seeing is the representation of a handful of stocks that are controlling the entire index. In this situation, we're taking it to the next level. It's like looking at an X-ray. We're looking at the number of stocks. This way, the stock itself, the weighting of the stock will not make any difference, okay? It will not make any difference at all because we're looking at the number of stocks out of 500, not the weight of that stock. So, for example, what do I see? And you can pull up this chart. You can pull this on bar chart. Every trading software has percentage of stocks above or below the moving average line. And again, we're looking at the 50-day and the 200-day. And what I want to see is I want to see the percentage of stocks, if I'm going to go bullish, above the 50-day moving average to be between 55 and 65%. So 55 and 65% of the stocks to be above the 50-day moving average and the 200-day moving average. What happens if I see 80% of stocks above the 50-day moving average and the 200-day moving average? The odds of that the market is getting overbought, and we're going to have a little pause. So you want to see just a ripe amount of number, 55 to 65, that's the ripe number of stocks above the moving average to confirm that you're going to go long. If the number is getting too close to 80%, the market's going to be overbought. And again, we're looking at this because stocks have different weighting when you're looking at them separately, when you're looking at them on a chart pattern. But when you're looking at them like this, they represent exactly the right balance because you're looking at a percentage of the stocks out of 500 stocks instead of the market cap. So again, 50-day moving average, 200-day moving average, we want to see 55 to 65% above it if we're going to go long. If we're going to go short, we want to see 55 or 65% below it. And if the number's getting too much above 75 to 80, the market's getting overbought. And if you see too many on the downside, if you're looking at a cool-off period and you see that 80% of stocks are trading below the 50-day and the 200-day moving average, that means the market's overdone. So it works both ways, to the upside and the downside. Hope that helps.